Hi guys, welcome back to In Case of Econ Struggles. Welcome to another asset pricing struggle. Today's part 2, talking about the Lucas Tree asset pricing model. So we're really quickly going to review part 1. The full part 1 video should be popping up in the top right corner right about now. So if you haven't had a chance to take a look at that, I highly recommend doing that because in part 2 I'm going to skip over a lot of the things we did in part 1. And then we're just going to finish up what I think we should talk about with respect to Lucas Tree asset pricing. If we get to the end of this video and there's something that you think I missed or something you did in your classes you don't understand and you'd like me to try and cover, definitely feel free to put that in the comments below. I'm covering the Lucas Tree based on what I've done in my program, but of course it's not everything. So again, just let me know in the comments if there's something that you want me to cover, but I haven't. All right, so let's get into it. So remember that from the part 1, we talked about the goals of this video overall, and then I talked about how we needed to split this up, otherwise this video was going to be way too long. So in part 1, we talked about the setup and we derived the price for the Lucas Tree asset, and I'll go over that equation again very briefly. But now in part 2, what we really want to do is we want to derive the price of this risk-free bond in the model, and basically we want to compare the return of the stock, which is the Lucas Tree asset, to the bond or the risk-free bond. So as usual, timestamps are below if you would like to jump around. Let's go ahead and get right into it. So in part 1, we talked about this sort of setup. We talked about building the Lucas Tree. But the main thing that we did in part 1 that was important is we talked about setting up Bill's maximization problem, where we had a more complicated budget constraint than some of the other models that we've seen. So all we did is we cleaned that up a little bit. We talked about exactly what PT and DT were, and then we went ahead and used some first order conditions to find PT. And we found that when we had to find this PT formula, it started to get really complicated. And the reason it started to get complicated is because the price today was dependent on the price tomorrow, which was dependent on the price after, which was dependent on the price after. So we had to do a bunch of substitution, and it went on and on and on. And then what we did is we sort of combined that into a summation. We took the limit as t went to infinity. We said that if we bound PT, you can eliminate the last part. And so we found this lovely function for PT, which was basically the stochastic discount factor times future dividends, all summed together in expectation. And this is useful because the return for any given asset is just going to be sort of like 1 over the price today. And so we're going to need this formula again later. And so I think it's useful to go ahead and really quickly go over that. But again, that's what we did in part 1. And now in part 2, we're going to come back to this maximization problem, start thinking about what is the price of the risk-free bond. So just really quickly, the maximization problem, it is the discounted sum of future utility, or the present value of all utility into the infinite future. I can choose how many Lucas Tree asset shares I want, but now again we're focused on this bond. This is my constraint, where my consumption plus the amount I spend for shares tomorrow plus the amount I spend for bonds tomorrow has to be equal to what I get in terms of the value of my asset and the value of my bond, because we said there are no endowments in this economy. And so to get the price of the risk-free bond, I'm going to have to take the derivative of this Lagrangian in the first order condition with respect to bonds tomorrow. And so today's problem, I have lambda t, bt plus 1 pops in right here with a ptrf, so that's how I get that guy. In the next period, this is lambda t plus 1. This is a minus bt plus 1, so this is going to be just a 1 with a minus sign, which is how I get this guy right here. And now I can solve that for ptrf. And I remember from part 1 that lambda t plus 1 was just beta t u prime of ct plus 1. And lambda t was just beta to the t u prime of ct. Sorry, this is beta t plus 1. Beta t plus 1 times that. And what I'm going to do is I'm just going to name this thing. I'm going to name the stochastic discount factor, which is what this is. This stochastic discount factor, I'm just going to call it mt plus 1. Now I don't have to do that, but it is going to be really useful as I'm writing things if I can just use mt plus 1, and I don't have to carry around this ginormous fraction everywhere I go. So that's why I'm doing that. And you don't have to call it m, you can call it whatever you want, but that's what I'm calling it. So now we know that the return tomorrow is just 1 over the price today, which is just 1 over the expectation of mt plus 1. Now, one thing that I don't know is what if I don't know the expectation of this? What if I don't know exactly what the return tomorrow is going to be? What if I don't know what the return in any given period is going to be? Well, then I really need to find the expectation of our RF t plus 1, but I don't currently have that. And so what I'm going to do is I'm going to do a bunch of math just to be able to turn this guy into an expectation of a return rather than an actual return. Notice that that F was sort of a typo, so I really want RF t plus 1. So all the math tricks I'm going to do are just trying to get at that. And the way I'm going to do that is I'm going to use some expectations. So again, this is what I want, this is what I have, this is what it's equal to, and well, what I can do is I can just throw everything together on one side, and I can actually put this into the expectation. I'm allowed to do that mathematically, and so this is what I get here. And then if I want to re-expand this expectation, this is going to be the expectation of the stochastic discount factor. This is the expectation of the return of this risk-free bond. And then I need the covariance of the stochastic discount factor and the return. And I can use that to just solve for the expectation of the risk-free return tomorrow, which is just 1 minus the covariance over the expected stochastic discount factor. And this is useful because I can compare it to the return of my share, my Lucas tree of my stock in the next period. And all that's going to be is this is the return, so this is what I get, over the price. And so remember that the return of the risk-free bond is really 1 because I get 1 coconut divided by the price, which is why we could have 1 over PTRF. Maybe I'll just write that out. So remember that the return of the bond is I get 1 coconut tomorrow and I pay PTRF today. But with the stock, I get DT plus 1 plus PT plus 1 as my return, and my price is PT. So that's why I can compare these together. And now if I just sort of write these side by side, again, I don't know what I was thinking with DT, so I'm going to rewrite that as OT plus 1, which is what that is. Now, what you can see is that both of these returns are going to involve the stochastic discount factor because we talked about the equation for PT. But rather than do all the math, I sort of want to talk abstractly about how this works. And then if it's confusing, if you really need that math to figure out what's going on, drop a comment. I'll add a third part to this Lucas Tree asset pricing videos where I'll go through more of the math more analytically and try and make it make even more sense, but see if you can get it just on how I talk about it. So what I'm basically going to say is that the higher return for the Lucas Tree asset, you're going to get a higher return if the correlation between the return of the bond and the consumption in the next period is greater than 0. And why is that true? Well, basically what I'm saying is that if you're going to have a lot of coconuts tomorrow, then you basically are going to need to have a higher return from this asset. Because if you're going to have a lot of coconuts tomorrow, then you're sort of chilling. You're like, I don't really need to hold this risky asset because I know I'm getting a lot of coconuts tomorrow. So like, why would I wager on this risky asset if I can just throw it into bonds and have a lot of consumption tomorrow anyway? And so what needs to happen is that in order to get you to purchase this risky asset, the return on that risky asset needs to be even bigger if you're going to have more consumption tomorrow. Because I need to entice you to sort of wager your coconuts for an even higher return tomorrow, even though you already have a lot of coconuts tomorrow. So basically what this is saying is that if consumption is low and the price of the stock is low, then you sort of are like, well, I don't have that much consumption, so maybe I just want a lot of bonds. Maybe I want a guaranteed stream of income tomorrow. And so the return on that stock needs to be even higher to get you to take the risky asset. So again, if that's not making sense, please let me know in the comments below, and I'll try to add a third part to explain that better, maybe some more math. Any suggestions on that are super helpful. But this sort of wraps up how I'm going to talk about Lucas Tree asset pricing again if I don't get any comments. So if these videos have been helpful, please like and subscribe, and we'll see you next time for another case of econ struggles.